So next we're going to talk about your investment philosophy. And if you haven't yet, you're going to go in your lesson plans and you're going to take these 2 quizzes. The first quiz is from Rutgers. It's an investment risk tolerance quiz. What you'll do if you haven't is answer all the questions. I think there's like 18 of them, 13 of them, but you do have to fill out the demographic data at the bottom. And for this question, just fill it in the best you can. It doesn't really matter. And then you'll get your results there. The next quiz, I believe, is only 5 questions that you'll take right here. And these quizzes are just helping you figure out what your risk tolerance is, which goes along with our next part of our presentation, your investment philosophy. So you've gotten your results. Everyone has a tolerance level for the amount of risk they are willing to take on. And generally, you're divided into 3 categories: conservative, moderate, and aggressive. Your time may influence your investment philosophy, meaning your age. So if you are younger, you may be more aggressive. Older people might be more conservative, but you can be in any of these categories and your results would have kind of told you about where you fit in. Conservative means you're not willing to take many risks. Moderate means you'll take some, and aggressive means you'll take quite a few. So if you're an aggressive investor, what type of investment tools would you have in your portfolio? It would be the riskier stocks, which, going back to the last presentation, is going to be your speculative investments, your individual stocks, and then maybe some mutual funds or some of those kinds of things. Those might fall into more moderate as well. Portfolio diversification reduces your risk by spreading money among a wide variety of investments. So the goal is to create a collection of investments that will provide an acceptable return with an acceptable exposure to risk. So if you are very risky, you may make quite a huge return, but you may lose it as well. So it's finding the level of risk that you are comfortable with, and that will get you a decent return. Maybe you won't get 20% return, but maybe you'll get 8% return, 7% return, which is still very good. Oops. It reduces your investment risk by having diversification. And mutual funds are an automatic form of portfolio diversification because a mutual fund is already a collection of stocks and bonds, and even other mutual funds. And so by having that, you're already diversified because you're not having all your eggs in one basket. In the stock exchange, investments are purchased from a stock exchange, and that provides a central service to buy and sell all stocks, bonds, and other investments. There are stock exchanges worldwide, in the United States, but also in other countries. And only a limited number of people are allowed to buy and sell directly from each stock exchange. So we don't actually buy from the actual stock exchange. We're not at the New York Stock Exchange or the NASDAQ, but we go through a brokerage firm. So a brokerage firm facilitates the buying and selling of investments on the stock exchange. A full-service broker will offer investment transactions and a financial advisor, which is someone trained to help you make investing decisions. That's their job. Is to help you find out what your goals are and then what would be the best investments for you. A discount broker only is going to complete orders to buy and sell investments, and they do not offer advice. Online examples of this would be E-Trade, if you've seen commercials for that, or Fidelity. Those are discount brokerage firms in which you go online and buy and sell what you want versus a brokerage firm. The discount brokerage firm will usually charge a fee, though. The fees can include a service fee, a maintenance fee, an activity fee, and fees specific to an investment. So your best bet will be just to check out all your fees before you go through a discount brokerage firm. Total fees are often lower, but an individual must have some knowledge and some time to monitor your investments. So nobody's going to be saying, hey, you should sell this or you should go into here. You're going to be doing that on your own. A full-service brokerage firm is where financial advisors are compensated for their time and knowledge. So they're going to charge you a fee. It could be a percent of the investment value, a percent of how much you invested, or an hourly rate and fee. And depending on what broker you go through will depend on how that will rate. You just need to ask them. And financial advisors are paid, usually commissions by the company too. So keep that in mind that some of the money you make may be going to somebody else. It's important to research the financial advisor and firm you work for. Some questions to ask are, how are the firm's financial advisors compensated? How long have they been in business? Does the firm have a history of positive reviews and success? And how does the firm rank in comparison to other brokerage firms? You might be investing thousands of dollars in this company. So it's really important that you do ask questions. Make sure they're a reputable company. Make sure that they're going to be doing what's best for your money so that it can grow and you can make a lot of money, because there is a lot of money to be made. So tax advantage investments. Saving and investments are a form of unearned income, and therefore they are subject to income tax. So the government encourages people to use certain types of tax advantage investments. They reduce, defer, or adjust the current year tax liability. So that means you're not paying taxes either now or you're paying less of them. It just depends. So they're most common for retirement and education. When are taxes for tax advantage investments usually paid? There's a couple different examples. So in this first example right here, money is invested and taxes are paid. So the money grows untaxed with the help of compounding interest, and then the money is taken out and no taxes are paid because you already paid them. Here you invest the money tax-free. It grows because there's more to grow because it's not taxed, but when you take it out, taxes are paid then. So those are two different options, usually used for retirement. 403B, Roths are examples of tax advantage investments. So they're usually mutual funds, typically tax advantage for retirement, and the employer may match funds. And this is a great option if your employer does this. It's something you definitely want to check out. If your employer will match whatever you put in, so if you put in $300 and they'll put in $300, that's free money for you into your retirement account. But if you put in nothing, they will put in nothing. So you really want to look at that to see if your employer does that. Some examples, like I said before, are a 401k or 403b. These are for tax-exempt organizations like schools. 401k is most private businesses, and you can put money in them, and sometimes they'll match, sometimes they won't, but it's a way to save your money. And then personally, not through your business, you can do a traditional IRA or a Roth IRA. Traditional IRA, the taxes is taken out when you take out the money, so it grows tax-free. In the Roth IRA, you pay taxes right away, and then when you take it out, you are not charged taxes. So those are tax advantage investments. So, and lots of other plans. These are just a few examples of money or ways you can put your money. And you're going to put your money into mutual funds, usually in these instances. So the trade-off to tax advantages is most accounts have penalties if the money is withdrawn early. So in summary, investments are important to building your net worth. A trade-off to higher returns is lower liquidity and higher risk. So you're going to make more money, but you can't touch that money, and it's higher risk. Investments are ideal for the long term. Take advantage of that diversification. Discuss your goals with a financial advisor, and use tax advantage investments and employer-sponsored plans. Now, many people are scared to invest. They think that they're going to lose all their money. While there is a risk with money, there's a great potential for reward. So keep these options in mind, keep asking questions, and make informed choices so you can invest some of your money and have it grow to your benefit.